In the hushed canyons of Lower Manhattan, where masters of the universe traffic in billions with the click of a mouse, an unsettling trade was unfolding. Screens flickered red across banking floors as a great unwind roiled global markets on an ominous Monday in early August. It was a reckoning of sorts, a great repricing of risk after years of easy money and boundless investor exuberance. The numbers defied comprehension even for the most battle-hardened traders. In Tokyo, the Nikkei plunged 12% at the open, its biggest single-day drop since the 1987 crash. Across the East China Sea, South Korea's Kospi index hemorrhaged 9%. And when the opening bell finally clanged on Wall Street, the tech-heavy Nasdaq plummeted 6% in a matter of seconds, erasing $850 billion in paper wealth before frantic dip buyers stemmed the freefall. It was a near-perfect financial storm roiling markets on all fronts. Cryptocurrencies collapsed as the speculative mania gave way to panic selling. The VIX, Wall Street's fear gauge, exploded higher as investors scrambled for portfolio protection. And at the core of the maelstrom, a furious dash into treasury bonds, the ultimate haven in times of turbulence, sent shockwaves pulsing through the $24 trillion government debt market. Whether this bout of feverish trading marked the cataclysmic climax of a deepening global sell-off or the overture to a more protracted slump was impossible to divine through the fog of war. On Tuesday, some of the worst-hit bourses whipsawed higher, with the Nikkei roaring back over 10% and U.S. equity indexes mustering modest gains. But the remarkable intraday swings only deepened the suspicion that tectonic shifts were underway in the financial cosmos. At the root of the upheaval was the unraveling of key investment narratives that had turbocharged risk appetite and stoked unprecedented booms in equities, corporate debt, cryptocurrencies, and a host of other assets over the past decade. With eerie parallels to the run-up to the 2008 debacle, these firmly held market mantras now appeared naive at best in the harsh light of hindsight. The first and most sacrosanct was the invincibility of the U.S. economy, which had powered through crisis after crisis largely unscathed. Its resilient dynamism, turbocharged by fiscal stimulus and the brilliant innovations of Silicon Valley, was supposed to be impervious to the pedantic frictions assailing rival powers. Embedded in this deep-rooted American exceptionalism was the unbridled faith that world-beating U.S. tech giants like NVIDIA, whose shares had skyrocketed an astonishing 1,100% in under 2 years, would effortlessly harness generative artificial intelligence to usher in a new industrial revolution. But as the breakneck earnings expectations for the tech leaders started missing the mark, it stoked fears that the AI growth thesis had been prematurely priced into stretched valuations. The once unshakable investment theses underpinning trillion-dollar valuations buckled under their own weight. The second pillar was the fanciful notion that Japan's policy pendulum would remain stuck in perpetual easing mode. For years, investors had gorged on the world's most affordable financing by borrowing in yen and plowing the proceeds into higher-yielding assets in Mexico, Turkey, and other emerging markets. The assumption that the Bank of Japan would prove a steadfast oasis of accommodation, even as the rest of the world's central banks belatedly stampeded toward higher rates, had fueled an epic carry trade bonanza. But when the BOJ struck a hawkish tone in July and finally joined the global pivot toward policy normalization, it detonated a swift and brutal unwinding of these leveraged cross-border wagers. As the yen surged, punishing yen-funded positions across asset classes, the great carry trade unwind gained ferocious momentum. The risk-on bacchanalia of the easy money era gave way to a frenzied scramble for safety that left even professional investors reeling. "It's the great unwind," said Vishnu Varathan, head of economics and strategy at Mizuho Bank in Singapore, capturing the essence of Monday's violent market spasms. In the vernacular of traders, trying to pick the right moment to buy an asset that's tumbling is like trying to catch a falling knife. Today, there are falling knives everywhere. The great unwind had been a slow-motion train wreck months in the making, a collision of market fundamentals and tightening financial conditions long overdue. It laid bare the folly of loading up on speculative bets like meme stocks, dodgy crypto projects, and esoteric volatility products with eyes firmly shut to the growing threat of rising borrowing costs and the Federal Reserve's most aggressive campaign to restrain inflation since the 1980s. "We were complacent for too long," confessed a senior trader at a major Wall Street bank who spoke on condition of anonymity amid the unfolding chaos. The Fed's tough talk should have been a reality check for everyone taking excessive risk, but too many people thought the music wouldn't stop playing. Well, it just did. The tremors rumbling through global markets were particularly alarming given the unprecedented tide of leverage, that has flooded the financial system over the past decade and a half. Encouraged by rock-bottom interest rates and a prolonged drought in market volatility, hedge funds, corporations, and other investors had gorged on record amounts of debt, setting the stage for a vicious deleveraging cycle. Nowhere was the pervasive frothiness more evident than in the craze for private equity, which erupted in the era of easy money as yield-starved investors desperate for decent returns frantically plowed money into leveraged buyout funds and private credit vehicles. With fees enriching elite fund managers, the leveraged finance machine churned out a dizzying $3.3 trillion in new loans and junk bonds between 2019 and 2021, eclipsing the prior three-year peak in the run-up to 2008 by over $400 billion according to LCD, a unit of S&P Global Market Intelligence. As investors scooped up these opaque securitized loans known as CLOs, lending standards deteriorated, covenants weakened, and creativity in financial engineering flourished with such exotic debt instruments as SPAC debt, recurring revenue loans, and others worthy of the pre-crisis moniker toxic waste. This unchecked credit binge created enormous systemic vulnerabilities that risk amplifying any downturn as the easy money era draws to an anguished conclusion. In the last decade, the financial system has basically rebuilt all the same risks that blew up in '08, laments a hedge fund manager who piled into bearish options trades earlier this year anticipating the bursting of the everything bubble. But this time there's no Bernanke or bailouts coming to the rescue. The punch bowl has been taken away for good. This great unwind created collateral risks large and small which threatened to spread contagion through an intricately interconnected global financial system. Most perilous among these was the risk that large enough market dislocations could disrupt the intricate plumbing and intermediation of credit, choking off the flow of funding vital to the smooth functioning of the real economy. It was precisely this danger of freezing up lending channels and tipping the economy into outright recession that prompted increasingly strident calls on Wall Street for the Federal Reserve to swiftly pivot and start slashing interest rates, perhaps even cutting ahead of the next scheduled policy meeting in September. If financial conditions deteriorate, particularly in regard to credit market liquidity, the Fed should ease, Ed Al-Husseini, a rate strategist at Columbia Threadneedle Investment, said on Bloomberg TV as the market rout intensified Monday. The case for acting, whether it's an intermeeting cut or just a more accelerated easing cycle signaling all year, the case for that is quite strong. Despite the S&P 500 officially entering bear market territory with a more than 20% peak-to-trough decline through the June nadir, Fed officials had remained steadfastly hawkish in the face of fierce market pushback, reiterating their commitment to wrestling inflation back under control as their paramount priority. Just last month, Fed Chair Jerome Powell had underscored that a couple of positive inflation reports would not be enough to declare victory against the entrenched price pressures plaguing American households and businesses. With headline CPI still running north of 9% annualized as of June, the Fed's dual mandate of maximum employment and price stability remains sorely out of kilter. But the sudden financial market convulsions of early August, threatening to unleash cascading deleveraging and a damaging credit crunch, raised the specter that the central bank's zeal to stem inflation could inadvertently tip the economy into an excessive hard landing. For the Fed to keep hiking rates aggressively into a vicious bout of monetary tightening would risk a rerun of the ghastly policy oversteer of 2008 that exacerbated the subprime collapse into a system-wide meltdown. It's a devil's bargain that has haunted every modern Fed tightening cycle. By moving too aggressively to squelch inflation risks, policymakers run the danger of overkill, inducing an unnecessarily severe retrenchment in spending that cripples growth. Too timid a response invites the nightmare scenario of a permanent upward ratcheting of prices that corrosively erodes consumer purchasing power and business competitiveness. This delicate calibration is further muddied by the inherent lagging nature of monetary policy transmission. With rate hikes filtering through to borrowing costs and spending patterns on a roughly 12 to 18-month timeline, aggressive front-loading raises the odds of a policy overshoot that overshoots the elusive immaculate disinflation sweet spot. Amid the cacophonous debate over whether an impending mild recession would be a necessary and growth sacrifice and to restore price stability or an unforced policy error inflicting gratuitous economic carnage, the market was sending an unambiguous signal. The frenzied investor dash for defensive havens like U.S. Treasury bonds reflected a soaring preoccupation with imminent economic contraction risks that eclipsed lingering inflationary anxieties. In the feverish bond trading, yields on the 2-year Treasury note, highly sensitive to interest rate expectations, plunged below those on the 10-year benchmark in a textbook illustration of a depressionary inverted yield curve. This ominous harbinger of economic distress has reliably preceded every U.S. recession over the past half-century. Ed Yardeni, the deeply respected market watcher who cut his teeth dissecting the Black Monday crash through the prism of signals embedded in the Treasury curve, saw eerie parallels to past panic episodes in the warped yield dynamics. Yet like in 1987, when doomsday forecasts of a brutal recession went mercifully unfulfilled, the bond market's dire pricing may be disconnected from the real economy's trajectory. The implication was that we were in or about to fall into recession, and that didn't happen at all. Yardeni, who has been advising institutional investors since the 1970s, said in a Bloomberg interview, "It had really more to do with the internals of the market. I think there's the same thing going on here. Indeed, markets have repeatedly succumbed to recession phantoms that turned out to be false omens during the long-running bull cycle. In late 2018, stoked by a brief yield curve inversion, fears of a downturn fed a 20% peak-to-trough plunge in the S&P 500 that proved short-lived. 12 months later, recession risks flared anew amid a messy pivot by the Fed that sparked turmoil in overnight funding markets before cooler heads prevailed. But the whiplash in sentiment witnessed across global bourses in early August shattered the usual somnolence of summer trading and roiled even the most tranquil of vacations. As staggering losses cascaded across virtually every asset class, market veterans found themselves scrambling back to their battle stations, suspending holiday plans with their families in London, the Hamptons, or Sardinia's Emerald Coast. Matt Maley, chief market strategist at Miller Tabak Plus Company, had braved the notoriously fickle British weather for a European getaway with his wife and children. But as sickening drawdowns rippled through equities, bonds, crypto, and seemingly every crevice of the financial markets ecosystem, he raced back to his London rental and fired up his trading laptop, retracing the well-trodden path he had walked over 3 decades before when confronted with the havoc of 1987's Black Monday crash. "You don't wake up every day like this," Maley recounted. "I remember how things got in '87. You couldn't just kick back and watch it burn this time." For the legendary Wall Street veterans who cut their teeth in the frenetic exercise of real price discovery during the pre-algorithmic trading era, a sense of dread laced with nostalgia hung like a pall over global trading floors. They had witnessed too many cycles of irrational exuberance curdling into abject panic, too many imbroglios born of unchecked speculation and cavalier risk-taking when money remained cheap and abundant. After the great moderation of the Greenspan years lulled investors into a misplaced sense of perpetual economic calm, the cataclysmic near-death experience of the 2008 financial crisis had been meant to serve as a harsh wake-up call, a once-in-a-generation reminder of the vulnerabilities that fester during protracted stretches of easy money and the painful deleveragings that inevitably follow. Yet the emergency surgery administered by the Bernanke Fed to resuscitate the financial system, slashing interest rates to zero and injecting over $3.5 trillion into capital-starved banks, set the stage for an even more virulent bout of speculative excess in the 2010s. Rather than restoring prudence, the radical steps taken to backstop the system institutionalized the blunt force doctrine of "don't fight the Fed" that emboldened increasingly bigger investment gambles. As the Bernanke put inflated into the Powell put, a new menagerie of opaque structured vehicles, penny stock penny casinos, and too-good-to-be-true investing schemes blossomed from the fertile soil of near-zero interest rates and abundant central bank liquidity. Like paving over a sprawling subdivision of ticking financial time bombs, the emergency monetary medicine administered to treat the previous crisis birthed the seeds of an even more ominous everything bubble. Fed chairs may have pivoted from Greenspanian brilliance to Bernanke's blunt academic approach to Powell's plain-spoken everyman communication style. But the elemental market narratives that underpinned the precarious foundation of each successive bull run remained stubbornly constant. The U.S. economic dynamo would power through any shock, unfazed by quaint bouts of risk aversion. And central banks had investors' backs, a veritable put option ensuring that any major sell-off would be backstopped by incremental easing and a bottomless wellspring of monetary stimulus. The events of August 2022 represented a violent rupturing of those entrenched investor biases, forcing a traumatic repricing of assets inflated to dizzying altitudes on a gusher of cheap money and moral hazard. Like the brutal 1994 massacre that followed the Greenspan Fed's first baby steps on a hiking cycle, or the rolling asset deflations of 2007 to 2009 that methodically impaled the housing and credit bubbles, this vertiginous sell-off represented a cathartic comeuppance to the speculative unii of the past decade. Yet for all the angst ricocheting from Seoul to Frankfurt to Manhattan, this great unwind may ultimately mark a healthy, if excruciatingly painful financial detox from years of monetary excess. A full and final severing of the Fed put philosophy that enabled the metastatic proliferation of frenzied gambling and casino capitalism hallmarks like meme stocks, SPAC manias, and an entire crypto market littered with alleged scams and digital frauds masquerading as revolutionary technologies. Unlike the near-depression maelstrom in 2008, which required overwhelming shock and awe intervention to restart the economic heartbeat, the latest bouts of market mayhem emerged from a position of outward strength, stubbornly resilient growth juxtaposed against a pernicious inflation virus mutating in the scorching heat of fiscal and monetary incaution. Lurking beneath the lucrative facade of the longest bull run in decades were latent fragilities, unsustainable pricing quirks, and a deepening chasm between Wall Street's wagers and the fortunes of Main Street households. While asset prices soared into the stratosphere, spearheaded by a vanguard of disruptive tech titans, the lived experience for much of the real economy remained one of secular stagnation, muted wage growth, diminished opportunity, and a self-perpetuating cycle of concentration enriching society's gilded vertices. The events of August's market unwind brought this grossly distended disconnect into stark relief. With so much of the nation's wealth creation captured by a narrow cohort while stubbornly elevated inflation eroded the purchasing power of paycheck-to-paycheck families, the investing casino became increasingly disconnected from the economic realities of most Americans. While feverish money printing by the Fed may have papered over the widening structural cracks of the 2010s aided by ephemeral fiscal stimulus injections, the cumulative impact of flooding the world with over $25 trillion in liquidity could only be inevitably Pyrrhic. The relentless torrent of easy money sowed the seeds of speculative mania across multiple asset classes, while utterly failing to reinvigorate the animal spirits and productive capital investment required to catalyze a durable Main Street revival. As inflated asset valuations from real estate and equities to crypto tokens and fine art became increasingly decoupled from underlying economic fundamentals over the past decade, the widening chasm fueled a socio-political backlash that rattled the very foundations of American-led orthodoxy on economic liberalism and free market capitalism. The great unwind of 2022 brought this epical reckoning to an inflection point, forcing an unsentimental repricing of risks on bloated stock and housing markets just as the inflation scourge spotlighted the breakdown of once unshakable anchors like globalization's disinflationary virtues and the Phillips curve trade-off between jobs and prices. While the trillions upon trillions deployed to avert a second Great Depression in the wake of the 2008 financial crisis may have forestalled apocalyptic economic ruin, the policies aimed at stimulating the economy back to vitality instead nurtured an unnatural dependency on cheap money among corporations, consumers, and investors alike. Perversely, the very medicine meant to heal entrenched deeper afflictions. On the corporate front, debt-fueled share buybacks and acquisitions subsumed productive capital outlays as the path of least resistance to bolster earnings and appease the slavering appetite of the investing hordes. Among consumers, the intoxicating brew of negative real borrowing costs and a deluge of mortgage finance enabled the reconstitution of a housing superbubble in cities and sunny retirement havens across the land. And, of course, on Wall Street itself, the money illusionists spun staggering new markets from whole cloth, devising intricate securitized products to inflate corporate credit to Baroque dimensions and conjuring the esoteric crypto Ponzi schemes that came to epitomize the sheer speculative folly of the easy money era. In their relentless prospecting for yield and alpha, too many investment behemoths abandoned financial discipline and prudential risk management. For years on end, these deepening excesses and fragilities were masked beneath the deceptive calm of endless money printing, the Fed's implicit promise to underwrite excessive risk appetites with a perpetual torrent of liquidity injections. But the moment that flows ebbed and reversed polarity, the entire rotten superstructure risked an unraveling into a purgative crash. The monumental hubris came in allowing reckless investor exposures to accumulate to such grotesque dimensions on the misguided assumption that the Greenspan, Bernanke, Yellen-Powell puts ensured that monetary guardrails would always be swiftly re-erected to circumvent major deleveraging perils. That epic miscalculation set the stage for August's sudden financial paroxysms to threaten a vicious negative feedback loop, where forced selling across asset markets drained liquidity and gummed up vital intermediation conduits in the credit arteries, strangling the bodily funding flows to the real economy. The last such credit crunch, sparked by the subprime mortgage debacle, had required a full-blown nationalization of mortgage giants Fannie Mae and Freddie Mac, an $800 billion taxpayer-financed bailout of banks, government seizures of finance houses like AIG, backstopping of the entire $3.8 trillion money market industry, and a barrage of Fed lending facilities to avert a complete collapse. Could the 2022 sequel spark a similar seizing of funding markets, necessitating overwhelming interventions to prevent a downward spiral? Early signs were not encouraging, as two major credit deals came unglued while leveraged loan prices plunged and warning lights started flashing in obscure corners of Wall Street's shadow banking system. Turmoil roiled the multi-trillion-dollar repo and commercial paper complexes, hallmarks of acute funding strains. For the Federal Reserve, the rapidly shifting financial terrain posed nightmarish scenarios and anguishing policy dilemmas. Having already embarked on one of the most aggressive monetary tightening campaigns on record to wring out decades-high inflation pressures, a sudden regime shift toward liquidity backstopping risked betraying the reset of price stability as the paramount goal.